Welcome back to the Deep Dive. Today we're tackling something that hits anyone who's just moved to the United States. You might be an immigrant, a student, you could even be a citizen who's been away for years. You face this credit conundrum.
Right.
You could have a perfect financial record in, say, London or Seoul, but you get here and suddenly you're a ghost. You're financially invisible.
And that invisibility is a massive systemic barrier. The sources we're looking at today really show just how big a problem this is. I mean, the whole U.S. financial system, it runs on credit history.
For everything. Renting an apartment, getting a decent insurance rate.
Financing a car, a business, any kind of loan. And the data, it really backs this up. An estimated 26 million Americans are credit invisible.
Meaning no file at all.
Nothing.
Yeah.
And on top of that, you've got another 19 million who are considered unscorable.
Those numbers are just staggering. So you're looking at nearly 45 million adults starting from absolute zero. We need a map, a clean, comprehensive guide to get through this. So that's our mission for this deep dive. We're giving you the shortcut, a step-by-step guide to building a U.S. credit profile, but safely. We'll show you the best tools and, just as important, the traps to avoid.
And those predatory traps are a big part of this story. But look, it all starts with one core problem. International banks. They just don't report to U.S. bureaus like Equifax or Experian. It's rare. So a new arrival really is starting from scratch.
So you have to solve two things right away, identity and security.
That's the foundation.
Which brings us to our first steps. We're going to focus on two things. The ITIN, that's the Individual Taxpayer Identification Number, and the most common starter product out there, the secured credit card.
Okay, so let's start with identity. This is mainly for foreign nationals who can't get a Social Security number, an SSN. The IRS issues this thing called an ITN. It's for tax compliance.
But for building credit, it's a key, right?
It's a major unlock. Some of the big card issuers, Capital One is a good example, they have programs that will actually accept an ITN instead of an SSN on certain applications.
And the requirements, I mean, they vary hugely between cards and issuers, right?
Massively. But just having that ITN in your hand.
It gets you out of those niche high-fee products.
Exactly. It gets you into the general banking ecosystem. And once you're past that identity hurdle, the first thing you're probably looking at is a secured card.
Right. So for anyone listening who hasn't run into one of these, how does it actually work? What's the mechanism?
It's basically credit that's backed by your own cash. You, the consumer, you put down a security deposit, let's say $500, and that amount becomes your credit limit.
That's collateral.
It is. It guarantees the lender against your risk. And here's the key part. You can't touch that deposit. Not until you close the account in good standing or they convert it to a regular unsecured card.
It's like training wheels.
Perfect analogy. It lets you prove you're responsible without the bank really risking its own money.
And when you look at who's using these cards, the data is, well, it's pretty clear they're serving the right people. Let's dig into the numbers our sources gave us on the financial differences. Secured versus unsecured cardholders.
The gaps are striking. Secured card borrowers, they have much lower stated incomes. The median is around $35,000.
Compared to $50,000 for an unsecured cardholder.
Right. But the real shock, I think, is when you look at the credit limits. That's where you see the difference in purchasing power.
Yeah, I mean, let's just lay that out. The average secured card limit is just under $1,400. The average unsecured limit, over $24,000.
It's a huge difference.
What does that actually mean for someone starting out in the real world?
It means your quality of life is immediately restricted. With a $24,000 limit, you can handle a major emergency, a big medical bill, a car repair.
Yeah.
You can handle it without maxing out your credit.
But with a $1,400 limit,
you're using that for, what, furniture, maybe some groceries. You can hit 50 or 60% credit utilization really fast, just living your life. It forces you to be incredibly careful just to keep a healthy credit score.
And that low limit and high risk profile, it translates directly into cost. You're basically paying a penalty just to prove you're responsible.
That's the core reality of it. Secured cardholders face way higher interest rates.
Yeah.
And they get almost no perks.
Let's put a number on that, the interest rates.
Well, fewer than 36% of secured borrowers had an interest rate below 20%. For unsecured borrowers, it was almost 56%, enjoying those lower rates.
Wow. And rewards programs.
Forget about it. Only about 12% of secured accounts had any kind of cash back or points. It's a bare bones product.
So it's high cost, low benefit, and it's designed purely to generate that positive payment history. But is there any movement to lower that burden?
The system itself is designed to reward stability, which just takes time. A big reason for the high costs is that about half of all new secured card borrowers, they start with no score at all.
That's the highest risk category for a lender.
The highest. But as we're about to see, competition is actually starting to change things. It's forcing lenders to speed up the process of getting out of this high-cost tier.
Okay, so if the secured card is the starting point, let's talk about the payoff. The goal is graduation, right? What exactly does that mean?
Graduation is the moment of liberation, really. The lender refunds your security deposit, that cash you put up, and they either convert your account to an unsecured card or they offer you a brand new deposit-free one.
It's the bank officially saying, okay, you're now eligible for mainstream credit.
That's it.
So what are the key factors? Is it just about putting in the time, or is it more about behavior?
Behavior is absolutely key, but it's all measured by your score.
Yeah.
Not surprisingly, the biggest factor is your most recent credit score. If you get your score above 620, you are way more likely to graduate.
Okay, but what's fascinating is what the data showed about that group that starts with nothing.
Yes, this was the aha moment for me in the research.
You mentioned the 19 million unscorable people earlier. You'd think they'd lag behind, right?
You'd think, but they did the opposite. They excelled. The unscorable population, the ones who started with absolutely no credit file, they were the most likely group to graduate.
That's incredible. And their scores.
Even more remarkable, when they got their first credit score, the median was 687.
That's not just good. That's well into the territory where you get decent loan rates.
It is.
So why is starting with zero history better than starting with a low history?
It seems to come down to discipline. The data suggests someone with a low FICO score, say in the 300s or 400s, might already have bad habits, late payments, high balances, things they struggle to fix.
But the unscorable group is a blank slate.
They're a blank slate learning the rules for the very first time. And they're far more likely to be what the industry calls transactors.
Meaning they pay their balance in full every month.
Every single month. They're not revolvers who carry a balance and pay all that high interest. And for a bank, a transactor is the most valuable, lowest risk customer you can have.
So that distinction, transactor versus revolver, is financially crucial for you, the listener. If you pay your balance in full, you're using that secured card as a credit building tool almost for free.
Precisely. You avoid all those high interest rates we were just talking about. Low utilization and no late payments.
Yeah.
Those are the behaviors that signal a successful graduate.
Okay, now let's zoom out to the market itself. The data showed a huge jump in secured cards through 2016, but then things shifted. The composition of new borrowers is getting riskier. Why are lenders taking on more people in that low 300 to 580 score range now?
It really looks like it's driven by competition. As the market for these cards grew, lenders started looking more aggressively for new customers. To keep growing, they had to lower their standards a bit, scoop up people who might have been denied before.
So the whole system is getting hungrier for volume.
It is. And that hunger is actually speeding things up for the consumer.
Right, because the data also shows that graduation is happening faster for newer groups of customers.
Yes. The time it takes an account to graduate is getting shorter. And that's a great sign. The theory is that it's all about poaching risk.
Meaning, if one bank doesn't upgrade you, another one will steal you away.
Exactly. If you prove you're responsible for 6 months, your bank needs to upgrade you fast. Otherwise, a competitor will see your new good score and offer you a better card. Banks are fighting to keep these promising new clients.
Okay, so we've established the secured card is the gold standard for starting out. But what if you have international connections? Are there ways to just skip that stage entirely?
Absolutely. The first strategy is to leverage your existing global banking relationships. If you already have accounts with a big international bank like HSBC, Citibank, maybe Bank of America, in your home country,
They might have a program to help you.
they might. They can sometimes use your existing history with them to open a U.S. account. The best-known example is the Amex Global Transfer Program. It can let you transfer your credit history from your home country to qualify for a U.S. Amex card.
That's a massive head start. What about the newer options? The ones from fintech companies built to solve this credit invisible problem?
We're seeing a boom in what they call alternative credit cards. These companies basically ignore the traditional FICO score because they know you don't have one.
So what are they looking at instead?
They use their own underwriting models. They look at totally different data points. Things like your banking history, where you went to school, who your employer is, or even just straight up income verification.
So they're creating new pathways for people who'd otherwise be stuck.
Exactly.
And if you don't qualify for those and aren't ready for a secured card, are there any other building blocks left?
There are two powerful ones. First, a cosigner. If you have a trusted friend or relative in the U.S. with good credit, that can open doors instantly. Second, and this is getting more effective, is using rent reporting services.
Right, you're paying rent anyway.
You're paying it every month. These services take that payment history and they report it to the credit bureaus. And since payment history is the biggest single factor in your score, this can build a file really quickly from nothing.
So when you're finally ready to pick that first product, what's the number one thing you have to check?
You have to verify beyond any doubt that the issuer reports all of your account activity to the three major credit bureaus: Equifax, Experian, TransUnion. If they aren't reporting, you are doing all of this work for nothing. Your score will never go up.
And what about fees? How much is too much for a starter card?
You should really aim for an annual fee of no more than, say, $40. And, crucially, avoid any card that hits you with steep activation fees or program fees just to open it.
Those are just traps.
They are. They're designed to take money from desperate people right at the start.
Okay, we have to talk about legal safeguards. What happens if you feel like you're being denied credit because of your status? I know that's not always illegal, but when does it cross the line into discrimination?
It's a very fine but critical line. It's defined by the Equal Credit Opportunity Act, or ECO.
Which protects you based on national origin, race, and so on.
Right. And the Department of Justice and the CFPB have been really clear. Banks cannot use your immigration status to illegally discriminate.
So they can't just say immigration status as a blanket reason to deny you.
Exactly. Now, they can consider it if it's genuinely necessary to figure out if you could repay a loan, like if your visa expires before the loan term ends. But the law says unnecessary or overbroad reliance on your status might violate ECOA. The bottom line is they can't use your status as a proxy for illegal bias.
And if you think that's happened, you have legal options.
We did, yeah.
All right, this credit building journey is full of positive steps, but we have to talk about the pitfalls. Predatory lenders often go after vulnerable groups, especially new immigrants who might not get how U.S. banking laws work. How do we even define that term, predatory lending?
Predatory lending is basically any unethical practice that's unfair, deceptive, or fraudulent, and it results in abusive loan terms. And it's aimed disproportionately at certain groups, the less educated, the poor, minorities, the elderly.
What are some of the common tactics?
One is loan flipping. That's where they constantly refinance your loan just to generate more fees for themselves. Another is charging for excessive hidden things, like single premium credit insurance.
Okay, now here's a critical warning about interest rates. I think a lot of people assume that if a rate is obviously abusive, state laws, usury laws will protect them. But with credit cards, that protection often just isn't there. Why?
This is a huge loophole in the rules that everyone needs to understand. Usury laws are generally set at the state level to cap interest rates. But because of federal banking laws, a national bank is legally allowed to charge the highest rate permitted in its home state.
Regardless of where the cardholder actually lives?
Regardless of where you live.
So if a bank is based in a state with no interest rate caps, they can just export that high rate to the entire country.
Precisely. It means that, in practice, for almost any national credit card, there are no effective interest rate limits anywhere. You're pretty much unprotected unless you fall into a special category.
Like the Military Lending Act.
Right, which caps rates at 36% for service members and their families. But for the average person, you have to rely on your own vigilance. The law won't save you.
That is a really shocking piece of information. Let's move to scams that specifically target immigrants, especially around legal help.
Newcomers have to be so careful here. You have to know the difference between a licensed lawyer and an immigration assistance service provider. These providers are not lawyers. They can't pick forms for you. They can't interpret the law. They can't give legal advice.
And there's often this dangerous confusion around the word notary, right?
Absolutely. In the U.S., a notary public is just a public witness for signatures. That's it. But in many other countries, especially in Latin America, a notario publico is a high-level lawyer. Scammers exploit that confusion.
Making people think a U.S. notary can give legal advice they're not qualified for.
For an exorbitant price, usually.
What about specific cash scams to watch out for?
Yes, unfortunately. Two common ones are the blessing scam, where con artists steal your cash or jewelry pretending it's part of a spiritual ceremony. Another is the lending circle scam, which preys on informal community savings groups.
And as a general rule, just stay away from things like payday loans.
Always. High-interest, short-term loans.
Uh,
They're so predatory that they're actually illegal in some states, like New York.
if you do identify a predatory practice or you're a victim of a scam, what's the best way to report it?
The fastest route is the Consumer Financial Protection Bureau, the CFPB. They handle consumer complaints against financial companies. You can file a detailed complaint right on their website, cfpb.gov,
Or you can call them.
or call their toll-free number, 855-411-CFPB. They also have a whistleblower program for confidential tips. Reporting doesn't just help you, it helps protect everyone who comes after you.
This has been such a crucial deep dive. To just quickly recap the roadmap, secure your identity with an ITIN or SSN. Start with a reputable secured card, or maybe use something like Amex Global Transfer. Keep your utilization low, below 10% if you can, and pay your balance in full every single month.
That's the formula.
And if you run into anything that feels unfair or deceptive, use those CFPB reporting tools right away.
And here's a final thought for you to take away from all this. We saw that the unscorable population, the people starting from zero, are graduating at the highest rates. We also saw that the market is speeding up that graduation process because of intense competition.
So the value of a long traditional credit file is maybe being challenged?
It's being subtly eroded by the value of demonstrated, immediate, responsible behavior. So here's the question. How might the success of this previously ignored group, combined with all these fintech alternatives, fundamentally reshape what we even consider a mainstream financial product a decade from now? And what does that mean for the future importance of a traditional FICO score?
A fascinating thought. Competition and consumer behavior really are changing the whole landscape. Thank you for guiding us through this.
My pleasure.
We'll catch you next time on The Deep Dive.